All right, everyone, welcome back. Today we're going to talk about the most common lease escalation structures you'll typically come across within a commercial real estate lease. Let's get started. So on the agenda for today, we're going to cover three main topics. First, we'll define what escalations are within a commercial real estate lease. We'll talk about the most popular or common kinds of escalation structures. And we'll end with some of the different ways in which owners justify or benchmark what their escalation amount will be. So lease escalations are, at its core, really just a way for owners to find a way to gradually increase lease rates through time. So it's a mechanism or a clause within the lease that gives them the right to change rent and to increase rent from one period to the next. Now, that period could be defined as 1 year from 1 year to the next. It could be defined as every 5-year periods. So there's a lot of flexibility in which owners will define periods and define how those rent increases occur. And that's in part what we're here to talk about. Now, one of the reasons why escalations are important to an owner of real property is that, to a degree, yes, it helps them earn more money, but by earning more money, it helps them combat or protect against inflation, which really makes commercial real estate one of the most popular asset classes for long-term owners of investments. Now, as you can imagine, if the rent is going to increase through time, that also helps build in a certain amount of appreciation from 1 year to the next. Because as income grows, likely so does the property's value. So from here, let's talk about the four main kinds of common lease structures. Now, the first one, believe it or not, is a flat lease rate. Now, I think a lot of you are probably looking at me like, all right, great, thanks for not telling me anything I didn't already know. But to tell the truth, I think it's a little more common than you'd expect to see a multi-year lease with no escalations. Now, from an owner's perspective, that's a little uncomfortable because you don't get to benefit from some of that increase, or at least to combat or protect against inflation. But to tell the truth, flat rent is a common lease structure. So if we have, in this example, a 6-year lease, the rent would be $100,000 a year for every one of those 6 years. It would be flat, no change, no growth. Now, the next is a fixed annual percentage or dollar amount change. So in this example, you'll notice that from 1 year to the next, so let's take a look at year 2, for example. From 1 year to the next, it's growing by a consistent, flat, fixed percentage rate. So 3% every year for the duration of the lease. So the difference from, let's say, year 3 to year 1 is $6,090. I wanted to point that out because it does compound, right? It's not just simply $3,000 a year. It's 3% more than the prior year or period. Next is a concept called step rent. And what makes step rent interesting is that it could be a combination of flat and fixed. So it will be flat for a certain period of time. In this example, you'll notice the rent doesn't change between periods 1 and 4, but then in the next period, in period 5, it increases by a substantial margin. And then it'll be flat again for the next flat period. And so in the same way that stairs or steps kind of go flat and then increase, flat and then increase, step percentage rent works in a similar way. So here you'll see that it may be flat from 1 through 4, a 15% increase in year 5, and then flat again thereafter. Now, percentage rent or indexed rent, I think, is the last most common structure. So in this case, you'll notice, highlighted in red, that the base rent changes from 1 year to the next. But the reason it does is because sales volume changes from one period to the next. So the percentage rent that the tenant pays is a function of how much revenue or sales volume they generate. So if they have a great year, let's look at year 4. If they have a great year, they'll pay a little more in rent. And if they have a poor or below average year, they'll pay a little less in rent. Now, if these are the most common structures, I think obviously there's a lot to be negotiated around. And one of those points is, what should that increase be? So if we're going to talk about, let's say, a fixed annual percentage rate, what should it be? Should it be 1% every year? Should it be 30% every year? What should that fixed increase be? So most owners will try to push for 3% annually. So here within the United States, that's a hair more than what long-term inflation is. So again, that comes back to that whole inflation protection value of having lease escalations built into a multi-year lease. So with this, we're saying, let's try to get 3% or 2.75% annual escalations. Now, another way to do this is a fixed dollar amount, but be careful, because as a percentage of the actual rent paid, that really means that you have a declining percentage from one year to the next. So it may not be as high on a percentage basis in the first year as it is, let's say, in the fifth or the sixth. Another option is to benchmark against some kind of index. So I referenced the Consumer Price Index, CPI, but there are many others. So if you wanted to relate it to what the CPI index is, at least here everyone knows what their rent will be at any point in time, because the index is publicly provided, publicly acknowledged, well known and understood. Now, maybe a less understood way to define it is maybe tenant revenue or tenant sales. So it's possible for us to say, how about sales revenue from one year to the next as the index, and we'll base it off of that. But what's the definition of sales revenue? So maybe if I'm a grocery store, does it include liquor sales? Does it include pharmacy sales? Does it include some of the auxiliary services that they may provide, maybe ATM revenue? And so the definition of sales is going to be a little tricky, and maybe that's why that one is certainly subject for negotiation. Now, the final point here is having a ceiling and a floor or language that speaks to the greater of or lesser of. So the landlord or owner friendly perspective is the greater of 3% or CPI. So you set a very high minimum. Now, you could also go the other perspective or the other direction and say, let's go tenant friendly, where you have a very low maximum. So the lesser of 2% or CPI as an example. So I think, as you can see, there's a lot of different ways for you to structure kinds of lease escalations within a lease, but keep in mind that that flexibility is something that you should take to your advantage to make sure that you're creating the strategy and the income profile you're looking for. So just to recap, we covered what are lease escalations within a multi-year commercial real estate lease. We talked about the 4 main common structures, and we wound down with some of the more common benchmarks or points of reference that owners use to justify the amount that they've chosen. All right, everyone. Thank you for the time. Look forward to talking to you soon. Take care.